Hey traders, this is Blake Morrow with Trader Summit. Make sure you join the most highly anticipated online free trading event of the year, October 21st through 23rd at tradersummit.net. We're gonna have so many great speakers for you for those 3 days. We have speakers like Danielle DiMartino Booth, Brent Donnelly, Mark Minervini, Peter Schiff, Danny Blanchflower, Helene Meisler, and many, many more. So make sure you do register, it's free. Also, our sponsor Eightcap will be giving away 2 iPhone 14s to 2 lucky winners just for registering. So what are you waiting for? I'll see you there. Hey traders, this is Blake Morrow with Trader Summit, and it's Friday, so I've got Jim Welsh from Macro Tides here. How are you, Jim?
I'm doing good, Blake. Thank you. How are you?
Good. It's a very, very long and wacky week, and I know we got a lot to talk about, but let me first of all say that, I know some of your consistent listeners, hey, if you like Jim and what he has to say, make sure you give him a thumbs up, make sure you subscribe to the channel, make sure you jump in and comment. Jim, as I've said in the past, I like to believe you're like the end all be all know all everything based on your experience. But, I'm sure people have comments about how they feel and how they're viewing the markets. And, jump down below and jump in the comment section, because I know, Jim, you'll peruse those. But anyway, welcome. And what do we make of the markets here? And I know you want to start off with CPI, but what do we make of the CPI?
Well, there's a lot of the CPI was a factor. We'll talk about Bank of England and what's going on there. Those, I think, were the 2 main drivers this week. But I think, again, well, in this past Monday's weekly technical review, my conclusion on the CPI was we could see the headline come down a little bit and see the core go up because of shelter. And that's pretty much exactly what happened. The headline went from 8.3 to 8.2, but the core went from 6.3 to 6.6. And a big part of that was shelter and a couple other items, food and medical services. So that's the conundrum. But shelter is a lagging thing. And this problem, if you will, is going to persist for months just because of the way it's calculated within the CPI. I think the Fed could talk about that, but they can't until the overall inflation rate is really coming down. Yeah. And we will see housing prices weaken in the next 3 to 6 months. They ticked down, I think, 0.5% a month ago. Rents have come down from 18% annual rate to 9%. So there's relief there, but the Fed needs the cover of seeing the overall inflation rate. So what this chart shows is core services, and what we can see is the dark blue, and the goods are the tannish. So what we're seeing is the darker tan, I should say. We're seeing energy obviously come down. We're seeing goods come down, but because the weights within the CPI for services dwarf those for goods and energy, the impact from the increase in services. People are going out, they're flying on airplanes, they're going out to restaurants and eating food. So these are the things why the inflation rate is likely to be somewhat persistent in the very near term. Again, I will reiterate, as we go out further in time, over the next 6 months, we are going to see inflation drop fairly significantly by the time we get to next March's CPI report, which comes out in mid-April. But this is the issue. And for the Fed, it puts them in a box where they don't have a choice of what they're going to do at November 2nd meeting. They pretty much have to go 75 basis points.
And that's kind of like if you think about the price action over the last couple of days, and I know it's Friday, but if you think about, we got this huge squeeze in the markets on Thursday, and today the markets have pulled back. Obviously there's other things that are boiling, but I think it's the market coming to that realization that the Fed they've got their hands tied, right?
Yes. And what occurred to me yesterday, Blake, is that we've all seen a movie where you're watching the characters and they're within the, the framework of the time that they live and the circumstances of where they are. And everybody always has free choice. But we're watching this movie and we realize that the characters really, they have a choice, but yet they really don't. And we're watching them as they start to make a decision, which we know is not going to turn out well. And that's really the tragedy of it. It's like events are pushing them toward a bad outcome. And to me, that's where the Fed is, that they're in a position now where they're dialed in to do 75 basis points. I think that's a mistake. And we'll talk about later. Lyle Brainerd, the vice chair of the Fed, gave a speech this past Monday. And so in the next few weeks, we're going to hear the Fed members continuing to talk about we have to raise rates up to restrictive level, hold them, all that. But I think when they get down into that meeting on November 2nd, there's going to be some additional discussion. And so this is 3 comments from her speech about monetary policy working with a lag, which is what I just mentioned. Hey, they've raised 300 basis points already, and they won't know the full impact of that until next March. We've seen central banks around the world also raising interest rates, and instead the Fed is kind of pushing that because as they raise rates, the dollar goes up. As currencies go down, when they import food and energy, it causes the domestic inflation in their countries to go up, and they're responding with higher rates. What she said I thought was noteworthy is that, okay, you've got these rate increases around the world, but the combined weight of those increases exceed the actual, whatever the numbers are. If you added up all the rate increases, whatever they total, it's more than that. Meaning that, wait a second, what's happening here is going to weigh on economic growth globally. And then finally, the fact that she said liquidity is a little fragile in core markets. Well, there's no more core market than the treasury market on the planet. And what we can see is the liquidity levels going back the last bunch of years, is almost as bad as it was at the height of the pandemic, which is one of the reasons why the Fed rushed in to, provide liquidity and everything else.
That's why it's really important to watch that MOVE index, right?
Yeah. And there's another chart I didn't include it, but the MOVE index for treasuries, it is higher than the volatility index for stocks, currencies, commodities in general. So in other words, we've seen a tremendous amount of volatility in a core market. So my point, Blake, is that when they get into that meeting room, there's going to be, I think, a lively discussion in terms of people expressing these views and concerns. They're going to go 75 basis points, but then it comes down to what happens inside that meeting room to address these concerns. Will Chair Powell say something, in the post-conference, the press conference thing where he says, hey, we're not, it's not that we're guaranteed that we'll do 75 basis points or something basically to get the market to go off, because already there's like a 2/3 chance that, based on what the market thinks, the Fed's going to do 75 in December. So either Powell opens the door a little bit, or after the November 2nd meeting, we hear more dissension among FOMC members. The last 4 or 5 months, it's very unusual to have them all singing from the same page. So I think this is going to be a key. When do they open up that door to say, you know what, one of these meetings, we're going to downgrade from 75 to 50. And we're going to get 2 more CPI reports. And the November one comes out the day before the Fed meeting on December 14th. So I think that's the key thing here is, when do we see those hints that they're going to downgrade? Now, if I'm right and that happens, the equity market's going to rally pretty strongly. Again, it's another head fake, because the Fed has said, yeah, we're going to raise rates to a restrictive level and then hold them there. And that's the part that I don't think the markets have reconciled, because that increases the probability of recession, earnings getting marked down, and so forth. So we're going to have more volatility as everybody waits on, what the Fed hints. And at some point in time, that is going to come. They are going to have to signal, we're going to do something less than 75 basis points at the next meeting.
Well, Jim, what does that mean for the dollar?
Well, just looking at the chart, we talked about this last week, that there was the potential that the dollar could go up to a higher high. When it hit its recent high at 114.77, the RSI was above 80, really high level. It would be classic. It then came down to that trend line of over the last 2-3 months. And so in a sense, 1, 2, 3, 4, this rebound is part of wave 5. The dollar goes up to make another new high, and the RSI would diverge. And to me, that would be a pretty good signal in terms of, okay, it's time to look to go short the dollar. Monday, I think, is a key day. The Bank of England has effectively drawn a red line saying, we're not doing any more buying after October 14th. So now we'll see if the gilt market, to a lesser extent, the currency market for the pound, can the gilt market behave without having yields spike again? And I think that's one of the key things that will have an influence on global bond markets. If they misbehave and the BOE has to then, hey, you know what, things are getting crazy again, we're going to have to step in. Yeah, the markets will be relieved, but it means that there's an underlying problem there that is not a positive. So I think Monday is going to be a key day, and I would say watch gilt yields.
All right, sounds good. Let's take a look at your next chart, which is, damn, I'm trying to grab it right now. Sorry, it's TLT. So
okay,
yeah, here's TLT.
Okay.
Now you've been pretty constructive on this.
Yeah, again, going back to December of last year, where you see up in the upper left-hand corner, the black number 4. To me, we've been in wave 5, and you can see the red numbers 1, 2, 3, 4, and now I think we're nearing the end of this decline. And as we've gone down, I've recommended 33%, 33%. The arrows show where those positions were taken. If you look at when the bond market bottomed in mid-June, and you go down to the lower panel for the RSI, you can see even as TLT was making lower lows in mid-June, the RSI made a higher low, a divergence. Yeah. We have potentially the same thing happening here. So what we need, obviously, what happened in mid-June was there was a reversal, and that has yet to happen. But I believe we're going to see bond yields come down because we're going to have more economic weakness appear. The Fed's going to continue to talk tough in the face of that, those early or more convincing signs that we're moving toward a recession. And I think TLT is going to rally. I think 110, 112, and potentially the August high, which is wave 4 of lesser degree, around 120, is possible. But it's the next handful of days are going to be probably potentially challenging. But ultimately, I think that's what plays out.
And I was going to say, it's scary, when you have markets that are very one directional like this, and there's so many markets, whether you're talking about the dollar, or you're talking about yields, which or the bond market, which obviously this is like the driver of like every market. So it seems when you have these one-way markets, yet there's some divergence. To me, it's just we should definitely be careful, should be on the radar, but you probably want a culmination of reasons to be buyers here, right?
Yes, and I would say I probably have jumped the gun a little bit. I didn't obviously expect or anticipate what was going to go over in the gilt market. Yeah. But that it is what it is, right? But you're 100% right. I mean, normally to me, it's kind of like you take modest positions, and then when the price reversal confirms those prior positions, you add. Because hey, it's finally starting to happen.
Well, let's talk a little bit about the S&P here. What does that mean for the stocks? Because we had this like huge reversal yesterday. Yep. Do you think that was the bottom?
No. Again, as you know, for some time I was looking for the S&P. I mean, going back to mid-August, I said it was time when the S&P was at 43.25. Time to lighten up. We're going back down to the June lows. Over the last couple of weeks, my expectations, we were going to take it out. The 50% retracement of the move from March of 2020 at 2190 on the S&P to this January's high at 4818 was 3505. So my expectation has been this, one way or the other, we're getting down there. We did yesterday morning on that gap down. But I think positioning hedging and all the rest really made a difference. And it, once the S&P recovered from being down 80, turned positive, the intensity of the squeeze was very, very high. So the red line that I've drawn there is at about 35.70. To me, that is the line in the sand. I think there can be another pop to the upside. But if the S&P drops below 35.70, I think we're going to lower lows.
So
it's a treacherous time.
It is, but let me ask you this: if we stop here at like 35, let's just say you're right, and we get to like 35.80, 35.90, would you label this as a 5 then?
No, okay. I don't believe so. Again, tying the fundamentals with the technicals. Yeah. To me, being oversold, sentiment being very negative, there's the potential that you're going to get a relief rally. But I think going out the next 3 to 6 months, the market still has to contend with the Fed not backing, unless there's some kind of financial accident. Well, the market's not going to react favorably to a financial accident if it's serious enough to cause the Fed to pivot. And it would have to be pretty serious because they seem pretty resolute. So I just think there's the potential, Blake, that, you get these near-term rallies, but longer term, the market has to accept that the Fed's going to keep rates higher at a longer period. The probability of recession, I think, is really, really high, and earnings have yet to be marked down.
Yeah, so and we are in earnings season. Yeah.
I mean, and again, a lot of people jumped to the conclusion that we were in a recession after the second quarter GDP report. I pushed back really hard against that for a lot of different reasons. I'd say the numbers since July have kind of verified, no, we're not in a recession yet. I think we're headed to one. I think there will be one that will be very apparent sometime in the first half of next year. But the reason why, the point being is, earnings may not be a catastrophe. If you're not in a recession and the economy is fundamentally okay, weakening, but still okay, some of the earnings are going to be okay. They're going to be decent. And with expectations starting to get ratcheted down, there might be some pleasant surprises. But it doesn't change the bigger picture. I think next year earnings have to get marked down because we are going to go into a recession.
Sounds good. All right. Well, let's I said sounds good. That doesn't actually sound good. That was like just,
it makes sense. Whether it happens or not, who knows?
Yeah. All right. Well, let's talk about gold, because gold has really just been, it's been sold. And isn't gold just like a byproduct of this dollar strength that we've been seeing?
Yeah. Inverse. Yeah. I mean, I think a peak in the dollar is the key to the markets, in part because the dollar will definitely come down once the Fed signals that they're not going to do 75 basis point increases anymore. Sometime between now and that December 14th meeting, that's going to get communicated. So in terms of gold, it made a low at 16.16. As long as that low is intact, I think there's going to be a move above 1750 that could make a run at 1800. But it is predicated and dependent on the dollar finally rolling over. And again, that could happen next week. If there's difficulty with the Bank of England and the gilt market early next week, the dollar could spike to that higher high that we've talked about. And that would pressure gold. But as long as it holds above 1616, that to me is the key level.
So I'm going to ask you this, Jim, and I want to just get your opinion here. Gold has always been hailed as an inflation hedge throughout my career, and probably even through your career. But here we are. Yes. The history books have been rewritten. Economic books are being rewritten. Do you feel that gold will at some point again become an inflation hedge, or is it permanently broken? Because we found out it's not.
Yeah.
Right.
Yeah. Well, there were factors in this last cycle. I mean, the dollar's rallied from July of last year. As you may remember, I was bullish at the dollar when it was down around 90. And so we've had this huge rally in the dollar, which again has been pressuring gold. The other thing, there was a huge rally in the middle of the last 16, 18 months in Bitcoin. I think some of the speculative money that would normally have gravitated to gold went to Bitcoin. I don't believe it's fundamentally broken for the long time, because ultimately at some point, my guess is, Blake, inflation is going to go from 8% and 6% plus on the core down to about 3%. And that's when additional progress is going to be very difficult. I think at some point in time, then the Fed is going to look at the trade-offs. Well, do we keep squeezing to get this last little bit of inflation out and cause maybe more damage to the economy, higher unemployment, or do we accept that 3% is workable? I think they'll make that decision. And it's at that point in time where gold might shine again.
All right. Well, pun intended. All right, Jim. Well, look, I love our Friday talks, but I want to ask, how do we follow your work?
Macrotides.com. And as always, if you would like to receive the October Macro Tides issue, which covers a lot of the stuff you and I have talked the last 2 weeks, Jim Welsh Macro at Gmail. I'll send you a free copy.
Thank you very much. And I appreciate you. And I know the Traders Summit community does. Remember, make sure you register for our Traders Summit event, October 21st through 23rd, free to register. And make sure you give Jim a big thumbs up too. All right, guys and gals, thank you for tuning in. Jim, thanks for joining us. We'll see you next Friday.
Always a pleasure. Thank you, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.